once again to an episode of Save It, Spend It, Share It, a podcast about finances and how to be accountable for everything that we have received. And today we have a very special guest. Thank you very much for being in our podcast. Here we have with us Steve Clement. He's a tax professional. And please tell us what you do.
Thank you. I appreciate joining you today. I'm a CPA, and I'm one of those few people who love taxes.
Oh, wow.
Most people run away from it, but I'm just the opposite. It's a fun, challenging area, but I get to help so many people. My goal is to save taxes, but also do it fairly. I work with clients in doing budgets. We talk about things other than taxes, like Social Security, like investments. But taxes is the main focus.
Oh, wow. So you like reading tax codes and getting updates on these regulations that, they have funny words. And
I've learned long ago, I never talk taxes with my clients. But I do read a lot about it. I do study a lot about it.
That's great. So for today, let's keep a layman's terms.
Absolutely.
So that way we can understand a little bit into what you do and learn. Because
Sure.
Taxes, it's professionals take care of the actual work, but everyone has to pay taxes.
No one's exempt.
No one's exempt. So I think we should have a level of knowledge of being comfortable of understanding our taxes. So that is the goal today, to kind of, anyone that's listening to this podcast, kind of trigger something of, hey, I should learn a little bit more about taxes.
Good idea. And I hope this does raise enough questions to make you ask more.
Absolutely. And, we just finished a podcast about budgeting. Mm-hmm. And when we're budgeting, sometimes taxes are not part of that budget.
They should be.
They should be. But guess what? Every time we remember taxes, it's in the month of April. I don't know why. But in April, it's like we're reminded of, oh, wait a minute, taxes.
It's too easy to have the accounting logic of, if it's in my bank account, I can spend it. That's
true.
Not the case.
True. I have a daughter. She's 14 years old. Okay. And it's very interesting because she told me, Mom, I want to work this summer. And I told her, well, you have all these other things that you could do over the summer, train for volleyball, train for all this other stuff at school. And she said, but I want to do something for fun. So I said, so you want to work for fun? And she said, yes, I want to work for fun. I said, well, I hope you stay with that idea of work being fun, for a while. But I'm also a little bit worried because now she's going to start earning money at a very young age and paying taxes. So how can I help her start that journey in her taxes?
So let's start with a little twist on the theme, everyone pays taxes. Mm-hmm. Yes, she's going to pay taxes because they're going to withhold Social Security and Medicare taxes. So yeah, she's starting to pay taxes. But there's the tax that we all think about when we say taxes, which is income tax. Mm-hmm. She won't pay any tax until she earns about $14,000.
Okay.
So up until you expect her to go over that threshold, she can claim exempt. The minute you go over, you need to be claiming and having taxes withheld. And for her, it would be claiming single. When you're dealing with a married couple, that's a little different, but we're focusing on your daughter.
Okay, so then she would not have to pay income tax on her wages.
That is correct.
Okay, and the threshold is $14,000.
That is it today.
Okay.
Can it change? Oh, yes.
We've seen a lot of changes in the last years, but that's great news.
Yes.
So now she is starting to accrue some portion in her Social Security.
She sure is. Interestingly, though, while she's paying into Social Security, she's helping me.
Oh, wow.
She's helping pay into Social Security so that I can receive some.
Uh-huh.
That's the way Social Security works.
Okay.
And when I say me, I'm talking generalities.
Yes.
When you are under the age of 18, that Social Security never counts toward, or your earnings don't count toward your Social Security.
Oh, wow.
Social Security is based on your top 35 years. So let's face it,
Okay.
you're going to earn a whole lot more at a later time.
Mm-hmm.
But they really start counting at age 18. So, yes, everyone will contribute to Social Security when you earn a W-2. So, she is paying some taxes here, Kathleen.
Oh, wow. Well, that's great to know, because then, I need to start thinking about her retirement. And that's something weird to say, because when I was in my 20s, I never thought about retirement. I started working, and it didn't even cross my mind that one day I was going to retire. It was like, that's like too way into the future to even think about. But now that I'm seeing her starting to work and, getting into that age group of going to college and all that, I want to make sure that I set her up for retirement, that I explain to her. So what would be the best way of guiding her through that process?
I like the idea of starting early. And I'm going to jump to an extreme. I have some parents who require their kids in the early years to put aside the majority of their earnings into retirement, into the Roth type IRA or Roth type 401k if that's offered.
Okay.
Most of us don't do that. I usually encourage people to start small, and every time you get a raise, take half of that raise and put it into the retirement account until you're at an age where you're earning pretty decent. You're maximizing your retirement contributions, which can be pretty sizable. If you start early, you won't have any problems retiring.
They'll compound over time.
Think of it this way. For most of us, every 7 to 10 years, your money doubles.
Okay.
And you don't think about it until you start seeing it at my age.
Yeah, I need to start thinking of that 7 to 10 years. How many of those?
How many doubles can I get?
How many doubles can I get from now to retirement?
Mm-hmm. And the earlier you start, the much better it is.
So at her age, can I open a Roth IRA?
Absolutely.
Okay.
Anyone who earns money can put money into a Roth IRA or have it deducted, if the employer allows, into a Roth 401k.
And where can I open a Roth IRA?
Your bank.
Okay.
Investment brokerage firms are another good source. My standby for a lot of people is go to someone like Fidelity or Schwab, open up an account and put the money into a treasury on money market account.
Okay.
Today, that's earning 4%.
Mm-hmm.
Not bad. At some time later, you may want to expand and go into true stock investments.
Mm-hmm.
But treasury money market accounts, that's pretty safe.
Which is sometimes what we're worried of. I don't want to be putting into the market and it crashes or so on. I just want to set them up of something that's going to compound over time. So I think that would be a great way of starting them.
That's a great tool.
Now, is there an income threshold when it comes to start opening a Roth IRA to be tax deductible?
Mm-hmm. You have to earn $1.
Okay. That sounds very doable.
As long as you earn something, you
Okay.
can put it into a Roth. You can put as much into, and when I say Roth, I should say IRA,
Okay.
because it could be a traditional, which
Mm-hmm.
is deductible, or a Roth, which is non-deductible. But the rule is you can put in as much as you earn up to the threshold, which today is about $7,000
In a year.
in a year.
So, you mentioned two different type of IRAs, the traditional and the Roth IRA. What's the difference between when it comes to retirement?
So Roth IRAs, you don't get a deduction for. You pay taxes on what you earn and set aside, but all the growth, meaning the interest you earn, the dividends you earn, capital gains that you earn, are totally tax-free
Wow. At the
You'll-
time of withdrawal and
when you
retirement.
withdraw in retirement.
Wow.
Sure, that's going to be a few years away for many people, but it's totally tax-free. You'll never pay tax on it, and I guess I better be careful about saying never with Congress.
Yeah, never. It's a strong word when it comes to taxes, but
Yeah,
in the future, who guess where we're going to be at? But yeah.
but Roth IRAs, from the day they started, have been totally exempt from taxes as long as you've held it a certain length of time. And someone starting young is going to well exceed that threshold. Whereas the traditional IRA, traditional 401k, you get to reduce your taxable income.
Okay.
My recommendation is for someone young, start with the Roth and keep it as a Roth IRA, because you have so many years of growth to build up. Someone my age, traditional. It's not going to grow enough to make it worthwhile to pay tax today. So that's kind of my theme.
So one, you pay taxes as you deposit, basically, and the other one, you pay taxes at the moment of withdrawal.
That is correct.
Now, you mentioned another word, capital gains. What are capital gains?
Oh, I promise not to use tax terms.
So
Shame on me.
let's go back on that. What are capital gains, and why, the traditional and versus the Roth comparison with capital gains?
So capital gains means something grows. So I buy a piece of property today,
Okay.
and it
Let's say
grows in
$100.
So whether it be stock or property, so I buy something for $100, and 10 years later it's worth $250.
Wow.
The difference is a gain called a capital gain, because it's gain on something you invested in, which the tax term is capital.
Oh, wow. So that's a big difference, paying taxes as you go of, the 100 versus the other one.
Correct. So within an IRA, a traditional IRA, you're going to pay tax as ordinary income when you draw it out. With a Roth IRA, the only reason I use capital gains is it's part of the growth process, and you'll never pay tax on that.
Oh, that sounds very advantageous, especially
is.
for my daughter.
For someone young, absolutely.
So, anyone that's listening to us, you have kids, they're starting to work. I use the example of my daughter that's 14, but it could be anyone, 18, 20s, just graduated from college and now starting their first job. Make sure that you put them into retirement. And also not only because you're setting them for the future, but you're starting to create a space for them in their budget to contribute towards retirement.
Very much so.
As when you graduate, you barely have expenses. Most of your expenses are fun expenses. You like to travel, you like to go out with friends, but it's still a manageable budget.
It is.
So if you adjust it at a young age, it's already going to be part of your expenses.
You don't miss setting the money aside.
Yeah.
And if you keep in mind, every time you get a raise, put half of it into retirement, you'll retire well.
Oh, wow. I wish I could go back in time.
You're talking to someone who didn't do it himself. As you said, when you're young,
Yes, absolutely.
you don't think about it a lot.
Yes. Yeah.
And I'm an accountant, and I still took a while for me to recognize that.
You know, I think it's a process of always learning.
It is.
You know, sometimes we are in the field of numbers, but there's so much to learn. And so many things that as we go through life, we're like, oh, you know, I could take advantage of this.
Mm-hmm.
But the good thing is that we now can help our kids or your grandkids.
That is correct.
Now that, you know, years of experience have taught us certain things. And that's the problem with life, that, you know, you don't learn everything at the beginning, you know. It would be good that the knowledge that we have now, we would have it at our 20s.
Oh, tell me. I can think back on so many cases I wish I had known. But it's the learning curve.
Yeah.
We all have to go through that learning curve.
Yeah.
I had a situation once where I made a royal mistake. And my boss called me in. And after reaming me out, he said, Steve, sometimes you have to be drugged through the knothole backwards a couple times to learn. Take care of this and move on. That was the best advice I ever got for all of us. We learn from our mistakes.
Yeah.
Don't regret them. Move on.
Yeah. Yeah. And
that can apply to setting money aside for retirement, setting money aside for that ugly word, taxes.
Yeah. And, you know, that's something, you know, so profound that when we are in a hole, it's very difficult to see the light. And I've heard a lot of stories of people struggling with taxes, and they can just not figure it out. Mm-hmm. So, and the problem is that like I mentioned before, most of the time, the problem comes in when you're in April. But guess what? You can't go back in time. Mm-mm. So what can we do to kind of strategize our way during the year, not waiting until April, but during the year? Is there kind of like some things that we should have as a checklist of, these are the things I should consider during my current year so I can prepare for the following?
First of all, make sure on your withholdings that you have enough withheld to cover your taxes.
How do you know you're having enough withheld?
The final judgment is always doing the tax return.
Okay.
And if you owe a little bit, have a little more withheld. Doing it up front, I'll be honest, even for us pros now, the IRS withholding tables, they're not the easiest to understand. Mm-hmm. In fact, I tell most clients, claim single unless you're getting too much of a refund back. And that's even for a married couple, especially a married couple who both work. Mm-hmm. The withholding tables for filing married is based on the traditional logic of the 1950s. Oh, wow. Wife doesn't work. Wife stays home. Today, we'd say spouse, because either husband or wife staying home. But that isn't today's environment. Mm-hmm. I dare say 95% of my clients, both husband and spouse, work. So if both work, claiming married significantly under withholds.
I see. And
I've had too many clients come in saying, why do I owe? I'm having taxes withheld.
Yes.
It's because the tax table assumes that one spouse is not working, and so the earnings are such that it puts you into a higher tax bracket. The withholdings are totally out of line. So if both spouses claim single, it usually works out.
Okay. So let's say that someone's listening to us and say, hey, you know what? That could help me because every year I have to pay when tax season comes. How can they make that adjustment with their employer?
For most of us, it's going online to the employer's website. But at worst case scenario, go to your HR department, payroll department, and fill out a new W-4 form.
Okay. So fill out a new W form, and then on the W form, you're going to have to select single.
Correct. It's called a W-4 form.
Okay. So W-4 form, we go back and select single, and that would withhold the maximum amount.
Correct.
To avoid paying taxes.
It withholds a higher amount.
Okay.
Never maximum. There are other places on the form you can add, subtract things. I tell most of my clients, just fill out single, sign the form.
And that should help the majority of...
That helps probably 90% of my clients.
Okay.
When it doesn't work, sure. I'll help you make adjustments, have additional amounts withheld per paycheck.
Mm-hmm.
And in fact, I have a number of clients who I tell them withhold X dollars out of each paycheck. And that's in addition to claiming single. Sure, you can claim married, but if you owe money, that's the first step to take. It's an easy first step.
Okay, so we have the first thing on our checklist. Identify if you every year have to pay an additional amount of taxes and go back and increase the amount that your employer is withholding. So that would be the first thing on our checklist. What would be the second thing?
In the middle of the year, take your tax software if you're using something like TurboTax, or there's something called a free file with the IRS.
Oh, wow.
Go back and look at that document. Or if you're using a CPA, go to your CPA in the middle of the year and say, here's where I stand year to date. Here are my pay stubs showing what my withholdings are each week and year to date. Does it look like I'm in line? I have a number of clients who do that, and I love having them come to me because that way at the end of the year we can smile. We don't have to cry.
I like that.
It's the clients who don't think about it,
yes,
who usually get the surprise that hurts. So those are the two essential steps. During the year, it's as simple as making sure you have the right W-4 amounts claiming single as a starting point for, I'd say, the majority of my clients. That's what I recommend.
Okay.
Even if you're married.
Okay, great. We have another item in our checklist. What about some tax strategies? Could we implement, what are some common deductions sometimes we miss and we could take advantage of?
So for those who are willing to do and want to do the traditional 401k, that's an ideal deduction because you can put aside up to $23,000, almost $24,000 today.
That's a lot.
And if you're, forgive me for using this term, a geezer,
okay,
someone 50 and above, you can put aside over $30,000. $31,000 is the number today.
And what is the age? 55 and above?
50.
50 and above. Okay. So it starts early, basically.
It starts early enough. So can you afford to do it? Most of us can't. But can we inch up that increment every year when we get a pay raise? Absolutely. If you do that, you can usually get close to that maximum contribution over time.
Yeah. And especially if you're having to pay taxes at the end, maybe you kind of get into a system of swapping of
Yeah.
saying, hey, you know what, instead of paying at the end, I'm going to increase my contribution so at the end
Yes.
I don't have. And creating that space, sometimes it's difficult.
Yep. So the other benefits or things you can do to reduce taxes usually mean tying into acquiring a home or charitable contributions.
Oh,
And I think charitable contributions is one of the best things you can do.
yes.
Now, keep in mind, for a single individual, we're talking $14,000 before you itemize. With a married couple, double that. It's actually closer to $30,000. So, if your contributions are below that area and you rent, yeah, standard deduction is probably better for the IRS. But interestingly, California still lets you deduct things at a much lower level. Their threshold's like 10 or 11,000. For a married couple, 5,000-6,000 for a single individual. So if you're earning anywhere near 50,000-60,000 a year on California and you pay a tithe, you can itemize.
Yeah. And the interesting thing about charitable contribution is that you're given to a purpose, to a mission of your income, basically.
Very much so. I can't say enough about the value of charity. Now, I have to be careful with my clients. Not all of them are church believers or church attenders. So I tell them, find your charity
Yes.
that really connects with you.
Correct.
Actually, most people like to give to multiple charities. I say keep it to a handful. Don't bring me $225 charity contributions.
Yes.
Find someone that you really enjoy and lavish them. In my case, it's my church. That's where I put my focus.
Why do you give to your church?
Why? I've never seen God. I've never been able to outgive God.
Oh, wow.
Let's put it that way. Remember the Israelites, how their clothes lasted forever, their shoes last forever?
Yes.
I think I'm seeing that with myself. I'm not someone who has to go shopping regularly. Some people enjoy it. I don't. And my clothes, yeah, they tend to last a while. It's little things here and little things there. Sometimes we don't see that maybe God blesses us by keeping things from happening where I have to spend money. Has God kept me from getting into a car accident? Has God helped me to stay away from injuring myself? Or has He helped influence my decision to where I've made the right decision? My personal bias is I can't outgive the Lord.
Amen.
So that's where I come. And we all have a need to share with others in order to be blessed.
Yes, absolutely. And I'm glad that you brought this up, because when we're giving taxes, there's a space to also help others. There's also space to support something that we're passionate about.
Yes.
In your case, it's your church, your home church, because you see the ministry they're doing.
Yes.
And you believe in what they're doing. And, for those of you hearing us, make sure that you connect with a charity. You could connect with a religious
Absolutely.
entity, with a school. What are some guidelines of when looking for a charity? What do we need to make sure that they have or they're registered under in order for us to receive a tax deduction?
So first of all, a charity has to qualify under IRS tax section 501c. I don't always pay attention to the exact codes, but you've got to be a qualified charity, first of all, and there's an IRS webpage that allows you to do a search. But for the most of us, if you're a church, you automatically qualify.
Okay.
If you're dealing with someone like Salvation Army or veterans or charities that help with animals, there's healthcare charities. These are all charities that do good work. Mm-hmm. There are ways to check online. Yes, you can be technical and go to some websites that do evaluate them, and they do a good job. But for the most part, you can tell if a charity's doing good. Yes, check them out, but make sure it's someone who's providing a service to others.
Yeah.
That's a key rule.
Yeah, supporting their community.
Mm-hmm.
So yeah, amazing how we could help charities and also at the same time receive a benefit basically of a tax deduction.
Oh, yes.
And what is the requirement that the IRS says? How can we prove that we've given them money? Is there a requirement on that?
There really is. So, first of all, don't give cash.
Okay.
The IRS will not accept anything where cash is given unless you get a receipt.
Mm-hmm. But if you forget about where you give and they didn't give you a receipt, it's not a good method.
No. The other is if your contribution is $250 or more, you're required to have a letter or a receipt that says some specific words. And those specific words are no benefits received. Now, what they're talking about is physical benefits, mm-hmm. not spiritual.
Mm-hmm. Something more tangible.
Tangible benefits. So if you give any donation $250 or more, it's got to say that. And I require my clients to bring those letters in.
Okay.
I want to see, because I've seen the IRS challenge it, mm-hmm. and I want to make sure they qualify for those deductions.
So supporting documents,
Yeah.
any contributions that you make sure that you file them, make sure that you have evidence that you've been
Correct.
supporting that charity. So that could be another way. And I want to ask you something else. While we're talking about tax strategies and how to find these deductions that sometimes we mm-hmm. miss, what happens also when we have a high deductible healthcare plan? What can we do?
Before we do that, let me say one other thing about
Sure.
charitable contributions.
Sure.
A canceled check or a credit card is sufficient documentation for donations under $250.
Okay.
So now let's switch over to...
All right. Let's move on to healthcare. So healthcare, I have a very high deductible plan. I've heard about HSA. How does that help me for my taxes?
I'm a strong believer in health savings accounts, HSAs. First of all, you get to reduce your taxable income by up to $6,000, $7,000, $8,000. And it grows a little each year. So some people may say, well, I'm healthy. Why should I set money aside?
Yes.
Even the healthy of us sometimes have an accident. Even the healthy of us need dental care that isn't always covered by insurance, or vision care. And money put aside into an HSA also can be used to pay for over-the-counter medicines.
Okay.
Which if you try to itemize it on your return, which is possible to do, it's got a pretty high threshold, but you are not allowed to deduct out-of-pocket medicine. So Band-Aids even qualify under the HSA. Little things. Mm-hmm. And most of us get that debit card that we use and just charge those things on it. It's a great way to deal with it. And it keeps building and building and building. It's yours forever.
Oh, wow. You can keep it, and keep on accruing, basically.
Keep on building it. Some employers have something called a health not a health savings account, but the initials are flexible spending account that you can do through an employer. Those die at the end of the year. If you don't use it, you lose it. HSAs, absolutely beautiful, because you get to keep that forever. And I have some clients who use that as a savings plan. They maximize it.
Great.
And they build it up to where they start investing. As long as it's someday used for medical, and yeah, when you're older, you will use it. It's a great tool.
Yeah.
So I'm a big supporter of putting money into a health savings account, but it does have to tie to a health insurance plan that has a high deductible.
And do you pay taxes on the gains or that interest that the account accrues?
Good question. No.
Oh, great.
As long as you spend it for medical.
Medical.
Yeah. You draw it out for any other reason, oh yeah, you'll pay taxes.
Yeah, that's a perfect example, because throughout our lives, maybe 1 year we were healthy, or maybe the next 5 years, and you all of a sudden have this huge medical need. And where do you draw money from? And every month you can ask your employer, hey, deduct $50, $100, so that way you can start contributing.
And that's the best way to do it. You can actually contribute directly yourself on top of that.
Okay.
So that's not easy to do. It's called taking money out of my current spending plan. Yeah. When it comes out of the paycheck, perfect.
Yeah. And you mentioned going at the middle of the year with your CPA. Let's say that the recommendation is, hey, you are going to owe taxes the following year. The question that they could bring up is, what if I contribute towards my HSA plan? Will that help me save some taxes?
You can add to that retirement plan, HSA plan. Both of them do have the same impact. It does reduce your taxable income. Now, does it reduce it dollar for dollar? No. It's whatever your tax rate is.
Yeah, correct.
For a lot of us, it's 12%. That's federal, but then you have California, which is going to add another percentage. So figure 15 to 20% for most of us. So minimum. And then it goes up from there.
And what is the last day they have to contribute so it can be a deduction on the following year?
For both of them, December 31, or the last paycheck of the year.
The last paycheck, okay. So we want to make sure that we're running to the postal or whatever, is to, so we can get that payment in.
Actually, it's got to be, for an HSA, it's got to be received by the 31st.
Okay, so not postmark, but receive, which is a great thing that I'm glad you bring this up, because there's some items that they'll accept the postmark. But then for this, the contribution towards the HSA needs to be received by
HSA must be received. Yes.
Okay, well, that's a great strategy. We've covered so many items that I think are going to be so helpful for everyone that's listening to us. So I appreciate the time that you're giving us to explore all these items. So we're going to close this podcast with a verse that I like, and that we find in Deuteronomy 25. This is the New International Version, and it says, "Do not have two differing weights in your bag, one heavy and one light. Do not have one differing measures in your house, one large and one small. You must have accurate and honest weights and measures, so that you may live long in the land the Lord your God is giving you." We've talked about a lot of strategies, a lot of ways, and in all, the Lord always requires us to stay transparent and accurate in everything we do.
Transparency is so key. And being accurate, yes.
So the Lord has given us many resources. We're entrusted. He has entrusted us so many blessings. And let's, everyone that's out there listening, this is just the first step of where to start.
Very much so.
Where to start in your taxes. Take a hold of them. Don't worry about it. If you're struggling, that's a good thing that you're recognizing. That's a great start of you understanding that you are struggling. So we're going to go into episode 2 of this tax section. So stay tuned and come back so you can hear more about taxes next time. For today, it's going to be everything, and it was great having you be part of our podcast today. Thank you very much. Have a great day.